Tariffs are taxes on goods brought into a country. Sounds simple, right? But these taxes can have big consequences. When the United States puts tariffs on imports, it makes those products more expensive for American businesses and consumers. This can lead to higher prices on everything from cars to washing machines. Think of it like this. Imagine your favorite store suddenly raised prices on everything. You'd probably buy less, right? The same thing happens when tariffs are imposed. People buy less of the more expensive imported goods. This drop in demand can hurt businesses that rely on those imports. It can also hurt businesses that sell to those businesses. For example, if a factory has to pay more for steel because of tariffs, it might have to raise prices or lay off workers. Tariffs are a big deal because they can affect the entire economy. They can lead to higher prices, job losses, and slower economic growth. That's why it's important to understand what tariffs are and how they work. President Trump has made tariffs a central part of his economic policy. He argues that tariffs are necessary to protect American jobs and businesses from unfair foreign competition. In 2018, he imposed tariffs on billions of dollars worth of goods from China, Mexico, Canada, and the European Union. These tariffs have had a significant impact on the global economy. They have disrupted supply chains, raised prices for consumers, and increased uncertainty for businesses. The tariffs have also led to retaliation from other countries, who have imposed their own tariffs on American goods. The Trump administration's use of tariffs has been controversial. Supporters argue that the tariffs are necessary to protect American jobs and businesses. They also argue that the tariffs are a negotiating tactic to get other countries to make trade concessions. Critics argue that the tariffs are hurting the American economy by raising prices and creating uncertainty. They also argue that the tariffs are ineffective in achieving their stated goals and are damaging to the global trading system. President Trump's decision to impose tariffs is based on a few key ideas. First, he believes that other countries have been taking advantage of the United States in trade deals. He points to the large trade deficit, which is the difference between what the United States imports and exports. Second, the president argues that tariffs will protect American jobs and industries from unfair competition. He claims that countries like China are dumping cheap goods in the United States market, making it difficult for American companies to compete. Finally, the Trump administration sees tariffs as a way to force other countries to negotiate better trade deals with the United States. By imposing tariffs, the thinking goes, the United States can pressure its trading partners to make concessions. However, many economists disagree with this approach. They argue that tariffs are essentially a tax on American consumers, who end up paying higher prices for imported goods. They also worry that tariffs could damage the global economy and lead to a trade war. Section 4. Winners and losers in the tariff game. It's important to remember that tariffs don't affect everyone equally. Some industries and businesses benefit from tariffs, while others are hurt. Understanding who wins and who loses in this complex game is crucial for investors. Industries that produce goods directly competing with imports might see a short-term boost. For example, American steel producers might sell more steel if tariffs make imported steel more expensive. However, this often comes at the cost of other businesses. Companies that rely on imported components for their products often face higher costs. Think of a company that makes cars. If the steel and aluminum they need to build cars become more expensive because of tariffs, they'll likely have to raise prices or cut costs elsewhere. Consumers are also affected by tariffs. Higher prices on imported goods mean less money in their pockets. This can lead to a decrease in consumer spending, which can slow down the overall economy. Section 5. Is a recession coming? The big question on everyone's mind is whether these trade tensions could push the United States and the global economy into a recession. A recession is a period of economic decline, usually marked by job losses and a shrinking economy. The truth is, it's difficult to predict with certainty whether a recession is imminent. However, there are some warning signs that economists look at. Tariffs and trade wars are often seen as potential triggers for recessions. When businesses are uncertain about the future of trade policy, they may hold back on investments and hiring. This can lead to slower economic growth. Additionally, if consumers are worried about the economy, they may cut back on spending, further slowing down growth. While a recession is not a certainty, The risk is real. It's essential for investors to stay informed about economic developments and be prepared for potential market volatility. Section 6. A world turned upside down. The global trading system, which has been built over decades, is facing significant challenges. The rules-based order that has governed international trade is under strain, and the future is uncertain. The United States, historically a champion of free trade, has taken a more protectionist stance under the Trump administration. This shift has created uncertainty and tension with its trading partners. Other countries are also adopting more protectionist measures. This trend towards protectionism could lead to a fragmentation of the global economy, with countries retreating inwards and erecting barriers to trade. The implications of this shift are significant. A more fragmented global economy could mean slower economic growth, reduced competition, and higher prices for consumers. Section 7. How to protect your money. In these uncertain times, it's more important than ever for investors to have a sound strategy. Here are a few tips to help you navigate the potential market turbulence. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different asset classes such as stocks, bonds, and real estate. Consider international exposure. While the U.S. economy faces challenges, there are still opportunities in other parts of the world. Invest for the long term. Don't panic over short-term market fluctuations. Focus on your long-term investment goals. Stay informed. Keep up to date on economic developments and market trends. Remember, investing always involves some level of risk. However, by being informed and having a well-thought-out strategy, you can position yourself to weather the storm and achieve your financial goals.